Decoding the investment dilemma. Factors to consider when choosing between actively managed and passively managed funds. Introduction. In the vast landscape of investment options, one of the fundamental decisions that investors grapple with is whether to opt for actively managed funds or passively managed funds. This choice, while seemingly straightforward, requires a nuanced understanding of the factors that differentiate these two approaches and their potential impact on investment outcomes. Unraveling this investment dilemma involves delving into the key considerations that can guide investors toward a decision aligned with their financial goals and risk tolerance. Investment philosophy. At the heart of the decision-making process is the stark difference in investment philosophies between actively and passively managed funds. Actively managed funds are guided by portfolio managers who aim to outperform the market through strategic stock selection, market timing, and in-depth research. On the contrary, passively managed funds, often indexed funds or exchange-traded funds, ETFs, mirror a specific market index, seeking to replicate its performance rather than actively making individual security choices. Performance and cost. Historically, one of the central debates in the active versus passive investment discourse revolves around performance and cost. Actively managed funds, with their pursuit of market-beating returns, often incur higher fees. The compensation for the expertise and research capabilities of fund managers can impact the overall returns realized by investors. Conversely, passively managed funds typically boast lower expense ratios, as they operate on a set-it-and-forget-it approach, mirroring the composition of a given index. While they may not strive to outperform the market, their cost-effectiveness appeals to investors seeking broad market exposure without the burden of high fees eating into returns. Risk tolerance and investor involvement. Understanding one's risk tolerance and preferred level of involvement is instrumental in making the choice between active and passive funds. Actively managed funds, with their dynamic strategies and potential for higher returns, may also expose investors to increased volatility and risk. Investors comfortable with a more hands-on approach, actively monitoring and adjusting their portfolios, may find actively managed funds in sync with their preferences. On the other hand, passively managed funds, by design, offer a more passive investment experience. Investors with a lower risk tolerance or those seeking a long-term, set-and-forget strategy may find solace in the stability and simplicity of passively managed funds. The decision hinges on the investor's comfort level with market fluctuations and the desired level of engagement in portfolio management. Market conditions and investment horizon. The choice between active and passive funds is also influenced by prevailing market conditions and the investor's investment horizon. During periods of market inefficiency or heightened volatility, actively managed funds may have the potential to exploit mispricings and generate alpha. Skilled fund managers can navigate market complexities, potentially outperforming benchmark indices. Conversely, in more efficient markets, where information is quickly reflected in stock prices, the benefits of active management may diminish. Passively managed funds, tracking market indices, become an attractive option during such times. Additionally, investors with a longer investment horizon may find the compounding effect of low-cost passively managed funds advantageous, especially in tax-advantaged accounts. Tax efficiency and turnover. Tax considerations play a pivotal role in the decision-making process. Actively managed funds, with their frequent buying and selling of securities in pursuit of optimal returns, may generate capital gains distributions. These distributions can have tax implications for investors, potentially eroding overall returns. In contrast, passively managed funds tend to have lower turnover, resulting in fewer capital gains distributions. This tax efficiency can be particularly appealing to investors looking to minimize tax liabilities and enhance after-tax returns. Understanding the tax implications of each approach is vital for making an informed decision aligned with an investor's overall financial strategy. Market coverage and asset classes. Another crucial factor to consider is the breadth of market coverage and available asset classes within each investment approach. Actively managed funds, with their focus on research-driven stock selection, may have the flexibility to invest across a wide spectrum of asset classes and market segments. This agility allows active managers to pivot based on market conditions and economic trends. Conversely, passively managed funds, while offering simplicity and cost-effectiveness, may be constrained by the composition of the chosen index. Investors with a preference for specific sectors, industries, or emerging markets may find that actively managed funds better cater to their targeted investment objectives. Conclusion. The decision between actively managed and passively managed funds is a multifaceted choice that requires a comprehensive understanding of individual preferences, risk tolerance, and financial goals. Each approach carries its own set of advantages and trade-offs, making it imperative for investors to conduct a thorough assessment of the factors discussed. Whether opting for the active pursuit of alpha or the passive replication of market indices, investors can navigate this investment dilemma with greater clarity by aligning their choices with a well-defined investment strategy. In the ever-evolving landscape of financial markets, a judicious blend of active and passive elements may be the key to constructing a resilient and diversified investment portfolio.